Hi everyone, and welcome to episode 7 of the Introduction to Forex Trading series. In this episode, we're going to be discussing the different trading sessions that occur throughout the day in the Forex market. The beautiful thing about the Forex market is the fact that it's open 24 hours a day, 5 days a week. Each day in Forex begins and ends at 8 PM GMT, Sunday through Friday. Because it's a global currency market, Forex has currencies belonging to all major countries. Because of this, there are different periods in the day which experience different types of trading activity. This activity corresponds to the business hours of the countries which operate these various currencies. These different periods of trading activity are called trading sessions. The three major sessions are the New York session, the London session, and the Asian session. It's important to understand that these different sessions do exist and are relevant for our trading. The reason why is because they influence the way in which certain pairs move at different times of the day. The most popular time to trade is the overlap period that occurs between London and New York, because this is the period in the day where the market typically sees peak volume. Peak volume occurs at this time of the day because this is the time window when many major banks, governments, and other large institutions are starting to conduct their business. So with that said, let's get started on this lesson. We're going to get started by discussing what volatility and volume are and how they impact our trading during different sessions. Volume refers to the amount of trading activity entering into the markets. In other words, it's how many units of currency are collectively being traded within the market. On the other hand, we have volatility, which refers to the degree in variation in trading price. For example, an instrument moving 50 pips up and down during the day is more volatile than an instrument moving 10 pips up and down throughout the same day. If you're unfamiliar with the term pip, it simply means percentage in point. So what this means is that a 100 pip movement would equal 1% of value, while 1 pip equals 0.01% of value. Percentage in point is a term very readily used in the Forex market, so you'll want to write that one down. The market is subject to constantly experience short-term variation in the level of volatility. For example, when a significant global event occurs, it instantly sends ripples through the financial markets. This effect is instant because there are always traders and high-powered algorithms trading fundamental news events around the clock. This type of volatility is difficult to predict, and it's just a part of trading in financial markets that we need to manage. We'll be talking more about how to manage this risk in episode 10. When thinking about volume and volatility, we need to make sure not to get confused between the two. Volume is simply how much is being traded, while volatility is how big the price movements are in the markets. We ideally want to be trading at a time of day where a large portion of daily volume is occurring, and when there is adequate volatility to capture large price movements. The highest trading volume typically occurs between the crossover period of London and New York, because both markets are open at the same time. Let's talk a bit more about volatility. When you're trading in the financial markets, you're going to see periods of high volatility and low volatility. It's important to understand how to identify this because it will impact our trading style. It's generally better to be trading in periods of high volatility as opposed to low volatility. However, during rare periods of extreme volatility, it's safer to stay out of the markets altogether. If you take a look at the image on screen, you'll be able to see an example of some low volatility price movement. As you can see, the movement is very slow. However, if we create a comparison here with this second image, you'll notice that the market is moving quite fast here. This is a good visual lesson in volatility. When the market is moving like this, we can see that there is volatility present. So now that you understand volume and volatility, let's get back to the sessions themselves. The reason why trading is possible is because the market develops behavioral patterns which can be predicted ahead of time. A major component of this is the fact that different currency pairs behave in different ways at different times. but there is an underlying consistency which can be identified if you stick with it and learn a particular pair's movements well. When you're first getting started on your trading journey, we highly recommend choosing one pair to specialize in. For example, our team specializes in Euro US dollar and USD JPY. Part of this process of specializing in trading a currency pair is trading it within a specific time window, and that typically means trading it within one session. If you can do this, you're going to increase your probability of achieving success in trading fairly significantly, because you're just going to have so much more opportunity to learn how your pair operates within a specific time window of the day. This might sound like something which is simple, but a lot of people just try and trade 28 pairs all the time, and because of that, they just never develop enough specialization to become profitable. Another major benefit of specializing in one or two pairs with set trading times is that you're now going to have a specific time of the day when you conduct your trading. This is also going to be a massive help for you on your journey, because it means that you're not going to be spending the entire day in front of the charts like some people do. Overall, this is going to have a positive effect on your trading because it's going to reduce trading errors and increase your trading focus. This is such an important point for your trading. There are so many traders who have a set strategy which does work in the right market conditions, but they don't fine-tune their trading to the point when they actually become profitable. And what's interesting about this scenario is that these traders have profitable strategies. Typically they've purchased that from a mentor, but they don't become profitable. And the fundamental reason why is because they don't achieve enough specialization. And so, despite the fact that picking a session and becoming a master of that session sounds like such a minor thing, it can actually be the factor which differentiates between a standard trader who doesn't achieve profitability and a good trader who goes on to get funded and develop a trading career. You do not need to trade everything. You just need to trade one thing very well. You can make more than enough money for yourself by simply trading one pair at one time of the day. So a final reminder, trading is a skill which pays for specialization rather than broad diversification. Now I'm going to display an image on screen which shows when in GMT time different sessions will start and finish. So you can see we have Sydney and Tokyo, which is generally considered Asia, and then we have London and New York. Now, despite the fact that there's peak volatility in that London-New York crossover, you can become profitable trading at any point of the day as long as you put the work in to backtest and understand your edge in the market at that time. Now, obviously we have people watching this video coming from all over the world. So depending on where you are, what I would recommend doing is pulling up a time zone calculator and using it to figure out when these sessions start at your specific time zone. So to do this, all you have to do is come to Google, type GMT, and then enter your time zone into Google. So for example, here in Australia, I could type GMT to Australian Eastern Standard Time, and that would then tell me when these different sessions are going to start and finish. I would highly recommend taking the time to do this because it's a very valuable set of information to understand. So that brings us to the end of this episode. The primary focus of this episode has been to educate you about the different trading sessions and how to understand the variations in market volatility and volume that occur during those sessions. Many traders don't pay enough attention to this concept. And as I've said throughout this episode, it is a genuine downfall point within their trading journey. Understanding when and where your strategy is most suited to capture volatility is a primary point of focus for a trader. Study this lesson well and it will improve your trading skill set. Thanks for tuning into this episode, and I'll catch you in the next one where I'm going to be discussing the different styles of trading. Thank you.